If you're active duty military or a veteran and you're trying to decide between a VA loan and a conventional loan, this video is for you. Most military buyers ask this question after they finally understand how VA loans work. And what usually happens next is they get pushed in one direction without really understanding why. So today, I want to walk you through VA loans versus conventional loans, side by side, not to sell you one or the other, but to help you decide which one actually makes sense for your situation. Let's start with the big picture. At the highest level, both VA and conventional loans help you buy a home. The difference is how they do it and who they're designed for. VA loans are a benefit earned through military service. Conventional loans are standard lending products available to the general public. Neither one is automatically better. The right choice depends on your goals, your cash position, your timeline, and how long you plan to own the home. So let's break this down one piece at a time. Down payment, this is usually the first difference people notice. With a VA loan, you can buy a home with 0% down. That's not a loophole, it's intentional. The VA created this benefit to help service members and veterans buy homes without draining savings, especially during PCS moves or major life transitions. With a conventional loan, down payments typically start around 3% and go up from there. Putting money down isn't a bad thing, but zero down gives you flexibility, especially if you're relocating, preserving cash, or don't want all your money tied up in the house. Next, let's talk about monthly cost and long-term cost. PMI versus the VA funding fee. With a conventional loan, if you put less than 20% down, you usually pay PMI, or private mortgage insurance. PMI is insurance that protects the lender, not you. Most of the time, PMI is paid monthly and stays in place until you reach enough equity in the property. Now, here's something a lot of buyers don't realize. In some cases, PMI can be paid up front instead of monthly. And depending on how the loan is structured, that upfront PMI can sometimes be financed into the loan or paid up front. That option can lower your monthly payment, but it usually increases your total out-of-pocket and long-term expense. So while upfront PMI can make sense in specific situations, it's not automatically better. With a VA loan, there's no monthly mortgage insurance. Instead, there's a one-time VA funding fee. That fee helps keep the VA loan program running without relying on taxpayers. And here's the key difference. PMI, whether monthly or upfront, is still insurance that protects the lender. The VA funding fee supports the benefit itself. And many veterans are exempt from the VA funding fee entirely. This is why it's important to look at both the monthly payment and the long-term cost, not just one or the other. Now let's talk about interest rates. VA loans often offer lower interest rates than conventional loans. Not always, but often. That's because the VA guarantee reduces risk for the lender. Over time, even a small difference in rate can translate into tens of thousands of dollars in interest. And this matters most if you plan to hold the home for a long period of time. Now let's talk about credit, because this is where a lot of unnecessary fear shows up. The VA does not set a minimum credit score. Lenders do. In practice, VA loans tend to be more forgiving with credit when the rest of the file makes sense. That doesn't mean anything goes, it just means the VA looks at the whole picture: stability, payment patterns, residual income, and conventional loans tend to be more rigid. If your credit is strong, both options may work. If your credit has blemishes, VA can often be the better fit. Now let's talk about cash, because this is where decisions often become emotional. One of the biggest advantages of VA loans is preserving cash. Zero down payment, no monthly mortgage insurance, often lower rates. That means more liquidity. With a conventional loan, you may bring more cash to closing, especially if you're trying to avoid PMI. And for some buyers, that's perfectly fine. For others, especially during a PCS or a life change, cash flexibility matters more than appearances. Now let's address something that causes confusion and bad advice: the strong offer myth. You may hear that sellers prefer conventional loans because they're stronger, and that's not entirely true. Sellers prefer clean contracts, reliable lenders, and clear communication. A well-structured VA offer with a knowledgeable lender can be just as competitive. The issue isn't the VA loan. The issue is when the people involved don't understand how it works. So with all of this in mind, let's talk about when each loan actually makes sense. VA loans are often a great fit if you're a first-time homebuyer, you're relocating or PCSing, you want to preserve cash, you plan to hold the home long-term, or you value flexibility. This is where VA loans shine when used correctly. And now the other side, because honesty matters. When conventional loans make sense is if you're putting 20% down or more, or you want to avoid the VA funding fee, if it's a subsequent use funding fee of 3.3%, or you plan to sell quickly, or you're leveraging a specific rate or strategy. This isn't about loyalty to a loan type, it's about fit. So let's land the plane. The final takeaway, the biggest mistake I see, is choosing a loan based on what sounds better, not what actually works better. VA versus conventional is not a popularity contest. It's a strategic decision. When you understand both options, you can choose confidently, without pressure and without regret. So if you're active duty or a veteran, the best loan is the one that fits your situation, not the one someone pushes you into. In future videos, I'll break down pieces of this decision, like the VA funding fee, entitlement, and VA appraisals, so you can go even deeper. If you're looking for clarity around VA loans and how they compare to other options, you're in the right place. One of the biggest mistakes I see military buyers make is choosing a loan type before they understand the long-term cost. If you don't want to realize you picked the wrong loan after you're already under contract, text loan type to 301-332-1589, and I'll send you a side-by-side breakdown.